Okay, so this week is the last week of our discussion of FX exchange rate determination. So today's objective is just to tie up loose ends with regards to the Marshall-Lerner condition that I talked about last week, right? How we can actually, what assumptions we need to make in order to tie a relationship between the spot exchange rate E with Y, right? We had to impose some assumptions so that we can say there's a transmission effect coming from changes in E and how that leads to an output effect. Why that's important is because some countries have these growth targets, through exports, and if they in order to justify these growth targets, they have to make a claim or make a case in which changes in the spot exchange rate or manipulation or adjustments in the spot exchange rate, for example, making the currency weaker, can have a material impact on domestic output, right? That's the whole thing with regards to the Asian tigers, as well as mainland China and Japan, right, in the 80s and 90s. Okay, so we need to kind of solidify that concept through what's called the Marshall-Lerner condition. I'm going to do that very soon. And the final topic on FX rate determination is I'm going to give you an augmentation of the UIP relationship so that we can account for different types of risk premium. Specifically, we can now think about default risk of a country that may impact the UIP equation in such a way that makes, for example, domestic deposit rates less attractive, right? Why is that? For example, if even though interest rates are high for a specific domestic country, you may not want to put your money in it because the likelihood that a country may pay back its debt is very, very low, in which case that rate itself is insufficient. You need some sort of risk premium adjustment to the UIP relationship in order to justify putting money in that deposit. So what we're going to do is relax the UIP equation a little bit so that we can add an additional term that is more or less a catch-all term to accommodate for other sources of risk. And the most obvious source is coming from the default risk, the likelihood that a country doesn't pay back their debts, okay? All right, so we're going to talk about that and how once we augment that equation, we can now think about what changes in the supply of sovereign debt can have an impact on the UIP equation. So we can actually think about different strategies now for a specific country in which they have what's called imperfect asset substitutability. Imperfect asset substitutability meaning that their debt is not as safe as other countries' debt. And if there's a difference between two countries' safetiness or riskiness of debt, then that can have an impact on the return on your deposit, right? Okay, so that's where we're headed. And the final topic we're going to talk about fixed exchange rates. That's the case for Hong Kong. Why does Hong Kong adopt such a exchange rate policy? And what are the pros and cons? And then force you to think about, what kind of scenarios would a pegged exchange rate be beneficial? And what kind of scenarios would that actually be harmful? So why would it be harmful? Think about currency. Think about George Soros during the UK, in which the British pound was actually pegged to the euro. So maybe you didn't know that during the 90s, the British pound at a certain point was actually pegged to the euro. And what he did is he kind of bet that the central bank wouldn't be able to maintain the peg. In order to maintain a peg, you need to, as you already know, in order to maintain a peg, you need to maintain an infinite convertibility of the euro to the British pound, right? Same for gold, but in the case for a fiat currency, it's the same idea. You need to maintain infinite convertibility. Once you run out of reserves to maintain that convertibility, you're going to have a currency collapse, which is exactly what happened to the UK. They had to force themselves off the peg, devalue their currency, and that's where George Soros made his billions, okay, in the 90s. Okay, so that's number one. When would it be helpful? Well, it could be helpful a pegged exchanger could be helpful in the case in which you're trying to escape what's called a liquidity trap, which is what Japan experienced during the after they encountered the recession. They cut their interest rates down to zero. There's no way for them to get out of it through monetary policy, right? If you cannot decrease nominal interest rates below zero, otherwise. So what does it mean to have negative interest rates? Think about it. You put your money in the bank, you have to pay the bank to leave your money in the bank, right? Would you ever do that? No. So it doesn't make sense to have negative interest rates. So how do you get yourself out of this so-called liquidity trap then? Right. This is where pegged currency actually can be helpful, and I'll talk about that. Okay, so that's today's agenda. Once we're done with today, next week we're completely doing a 90-degree turn, right? Or we're going to talk about just risk management topics. So just more is all finance, no macro stuff. Okay, so let's go over the quiz questions from last week really quickly. Most of you, yeah. Oh, sorry. All right, cool. Let me read quick question one. So most of you got, I think 90% of you got all of it right. So let me just walk through it quickly. Assuming the economy currently is experiencing high inflation, and an example of an appropriate discretionary fiscal policy is which of the following. So anything that talks about monetary policy is wrong, right? Because we're talking about fiscal policy. So C and B are all monetary policy actions. So if you chose that, that's wrong. A, reduce government expenditures on major government consumption projects. Okay, so that's obviously a fiscal policy decision, but in fact, it's actually a little bit fuzzy whether or not government expenditure can actually affect inflation. Okay, so that's kind of a question mark, but that's the best answer you have. Okay, so intuitively, if you have more demand for goods and services, that's going to drive prices up. But how long and the size of the impact, that's actually up to debate. But given this setup of the question, the other two options are monetary policy. So A is the best answer here. Quiz question 2, which of the following fiscal and monetary policy scenarios is most likely to increase the size of the public sector relative to the private sector? So public sector refers to the government and local governments, nonprofit organizations, blah, blah. So these that's what's referring to the public sector. The private sector is for-profit enterprises like Google, Apple, Procter & Gamble, whatever. Okay, so we just have to think about what kind of fiscal and monetary policy that would enlarge the public sector or shrink the private sector. That's how you should be thinking. All right, so based on A, B, and C, each of them have an option for expansionary fiscal policy and monetary policy. So let's just look at fiscal policy. So how do you increase the size of public sector using fiscal policy? You obviously increase government spending. Government spending, if it's in the form of tax cuts, it's different, but government spending usually is enlarging agencies, right? Government agencies, government programs, creating jobs by opening more offices and so forth. So you're having more government workers. So an expansionary fiscal policy would actually increase the sector, public sector, all else equal. So any option that says contractionary would be wrong. So this one's wrong and this one's wrong. All right. For the monetary policy, what sort of policy action would shrink the private sector? So if you think about expansionary monetary policy that would stimulate the private sector, right, by making credit easier, then obviously the opposite would be true, right? Contractionary monetary policy means making borrowing money harder, right, because interest rates are higher, and therefore you should expect a shrinkage of the private sector because they're the ones that need money to borrow so that they can pursue positive NPV projects, blah, 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 right? And so the answer you should be looking for monetary policy would be contractionary. So A states contractionary, so cool, A's here. Not contractionary monetary, this contractionary monetary policy here, but fiscal policy is wrong, so B is wrong. Expansionary monetary policy, that's wrong. Okay, so A is the best answer. Okay, so maybe some people misunderstood what the difference between public and private sector. So just in government speak, public refers to the government, private refers to private enterprises. So it's not just publicly traded companies, that's different. That refers to companies that issues shares, right, on a public exchange, which is different than what's called private shares. But both companies in this scenario would be considered part of the private sector. All right, last question. All right, Zimbabwe is a fictitious country. Zimbabwe here's developed an economy with high capital mobility. Capital mobility just means that there's no regulations that blocks the flow of investments, funds, and money. So an example, Hong Kong would be very, very high mobility. You can move money out, you can move money in, nobody cares, right? That's Hong Kong, and that's also Switzerland and Singapore. But China has very, very high capital immobility, right? They have very, very strict regulations, how much money you can withdraw from ATMs, how much you can move from Hong Kong and elsewhere and so forth. And yeah, there's a lot of currency you can't even buy, right? Okay, so Zimbabwe has high capital mobility. Deborah Isaacson is evaluating the Zim dollars, the national currency of Zimbabwe. Which of the following is most likely to lead to an appreciation of the Z dollars if Zimbabwe starts? All right, so we have a couple of options here. So appreciation means the dollar gets stronger. So if we're talking about monetary policy, you want something that's contractionary, right? You want to withdraw currency from the system. There's less money in circulation, which means the currency would be stronger. So loose here means easy money. Okay, so we're not making things easier if you want a strong currency. So A is wrong. A restrictive fiscal policy is the opposite of expansionary fiscal policy, because this is the wrong answer, because restrictive fiscal policy means you're cutting back on spending, but spending is actually what typically believed to drive prices and also the strength of a currency, right? More people demand your currency to buy certain goods and services. So B looks like it's not a good answer either. And lastly, an expansionary fiscal policy, yes, right? That's the opposite of B. Right? So that's the answer we're looking for. All right, so comments, questions on the quiz. Again, I think most of you got all of it right. So let's go ahead and move on. Okay. So last week I did give you a practice homework assignment. I won't ask you a question like this on the final, but it's something I think is interesting given the amount of information that was taught to you last week about those the derivatives that we looked at, right? Okay. So let me briefly go over problem set 5. You should look over it yourself, but just be reminded that I will never ask you a question on the exam that's this difficult, okay? All right, so question 1 of problem set 5. So given your understanding of the AA and DD schedules, you have those equations, right? And on this week's slides on the appendix, I believe that I've derived closed form formulas of the slopes, right, of the DD and AA schedules. And given the slope equation, you can actually do some comparative macroeconomics, meaning that you can draw some conclusions about a certain country's reaction to monetary policy given their relative differences in import and consumption behavior to other countries here. So in this question, you're asked to compare two types of country: a small country, for example, like the Netherlands, versus another country such as the United States. And then you have we make some assumptions about their consumption behavior. So in this question, we claim that this small open economy, such as the Netherlands, tend to spend a larger fraction of income on imports than large economies do. All right, so I'm giving you some sentences to work with. So in your brain, you should be thinking about, how do I convert these sentences into mathematical equations that I've seen in the appendix of this week's slides? Okay, so which I'll show you the formulas. Second question, second sentence, their import volumes are also more responsive to changes in their national income. So again, another sentence, another description of their import behavior relative to the country. And what should be clicking in your head is, okay, how do I convert this sentence to another mathematical expression? Right. But anyways, we'll walk through it. But let me get through the question. Does this imply that the DD curve in the Netherlands, a smaller and more open economy than the US, is flatter than the DD curve in the US? Okay, so let's just walk through the sentences that you just read here and try to convert it into math, okay? So the first sentence you saw is small open economies tend to spend a large fraction on income on imports than large economies. So what that means is that their propensity to consume domestic goods, okay, is a lot smaller than the US. And this should make sense to you, right? Large countries like China, like the US, maybe Australia, maybe the UK to some extent, they produce a lot of goods locally that everyone typically buys within the country. And so if they get wealthier, they're not going to use that money to import most of the goods, right? Most likely buy stuff within their country. The Netherlands, however, and other small cities like Hong Kong, Singapore, so forth, when people get wealthier, a large chunk of the money is going to imports because there's no domestic or local option, right? So another way to say this mathematically is that the sensitivity of consumption for the Netherlands, given a change in their national income, or another proxy for income, right, is smaller than the sensitivity or change in consumption, domestic consumption of large countries like the US, right? So based on this description, I think you can actually write out some mathematical description, right? The reason we're using these derivatives, so I'm using the partial derivative, means the sensitivity, okay? So the small change in C given a unit change in Y. Okay, that's what this is what these equations say. What is the amount of change in consumption, domestic consumption, when there is a unit change in Y? Okay, and then here I'm saying that the change in domestic consumption in the Netherlands, given a unit change in income, is smaller than the change in consumption, domestic consumption in the US, given their unit change in income. The reason I'm using these sensitivities or derivatives is because of this equation here, which I'll talk about later. Okay, so just know that it's all in the appendix of this week's slides. All right, second sentence. Import volumes are also more responsive to changes in their national income. So again, we're looking at a unit change in income, but instead of looking at consumption, domestic consumption, we're looking at exports, right? Namely the current account. So translation, the Netherlands are more likely to import given a unit increase in their income compared to large economies like the US. And if you want to write that out in terms of current account, you can, right? It's the reverse, right? They are more sensitive to imports, which means that the sensitivity of the current account is less, right? The positive change in the current account is less or even negative, right? Or more negative than the change in the current account for the US, given that unit change in income. So this should be negative, right? So the change in the current account with respect to income should be negative, but the change is more negative for Netherlands compared to the United States. All right, so given these two conclusions from the sentences you read in the homework question, and you want to know a closed form expression for the slope of the DD curve, we can derive it. You can derive it in the slides. I'm not going to have the time to derive it for you because I think it's a bit tedious, but it's there in the appendix, okay? And you'll notice that there's a lot of expressions that looks familiar, right? So this is what this is saying, is that the slope of E relative to Y, so a change in Y has its impact on E. Why are we looking at the slope of E versus Y? Because in the A and DD schedule, we're plotting everything on D versus Y, right? Right. We are working with this setup here. So we care about, now we want to understand the slope of the DD curve. So what we have as inputs now, we have the Netherlands as having a small number for the sensitivity of consumption, domestic consumption relative to change in income. So that's here. So 1 minus a small number is a bigger number, right? So partial C relative to partial Y is a smaller number than a developed economy, a large economy. So 1 minus a small number is a bigger number. Minus the partial derivative of the current account with respect to a unit change in income. So the Netherlands here is also a smaller number. So 1 minus a smaller number minus another smaller number. So the overall expression of the slope, all else equal, should be bigger, right? It should be bigger than the US. And so all else equal, because we made no other assumptions, right? No other differences. Assume there are no other differences between the Netherlands and the US. Then all else equal, the slope of the aggregate demand curve for the Netherlands is going to be steeper, right? Because the slope has a larger slope number than the US. And so if one were to plot this, it would probably look something like this, right? The Netherlands like that, and the US probably like that, right? So this is the DD curve for Netherlands. And this is the DD curve for the US. This is an example. It doesn't be any developed country. Okay. Right. So just based on the description, we can draw these conclusions about their aggregate demand shape, right? They don't have to be far apart. They can coincide. I'm just drawing it this way to show that they have different slopes, okay? All right, assuming that they have the same AA schedule, which is a very strong assumption, but just for the sake of this problem, the problem asks, would a temporary expansion in the Netherlands have a stronger or weaker effect on output? So we want to know if the output is stronger or weaker if they conduct expansionary monetary policy. So let's go ahead and do that with the AA schedule. We all know what happens, right? The AA schedule is going to shift up. So let's go ahead and shift up and then just visually convince ourselves of the answer. So we conduct expansionary monetary policy. We can look at the change in output for the US, which is this gap here, versus the change in output for this graph here. All right, so maybe I'm not drawing a good graph, but I hope it should be clear that this Y, this delta Y, let's write NL, US, this delta Y is smaller. You agree? Yeah, so all else equal, if the AA schedules look the same between the Netherlands and the US, and the Netherlands have a steeper aggregate demand function, if you conduct expansionary monetary policy, the output is going to be much more muted than in the case for larger economies like the US. Okay, so all we've done is basically just read a prompt. We thought a little bit about what the prompt suggests in the context of this equation, which is derived to you at the end of this week's slide. And based on, strong assumptions about, the the AA schedules across different countries, we can now actually do some comparative macroeconomic policy shock analysis, right? We can conclude that import-dependent countries like Hong Kong, like Netherlands, have a respond to monetary policy shocks less so than developed countries. So to some extent, you can make an argument that maybe it's a good idea to actually develop local economies, your local economy, so that local consumption actually has a helps, right? Actually helps boost, helps respond once you become wealthier, as opposed to depending so much on imports. All right, comments, questions on this homework problem set. So let me double check that it's in fact at the end of this week's. Yeah, so I do derive it all. Okay, so this is the current account response. We derived this before. This is the X. Okay, I'll talk about this later. Okay, don't look at this now. But here's the DD schedule derivation and the A schedule derivation. So I'm looking at the slope, right? So that's the slope. The trick to the derivation depends on two things. One is total differentiation, and the second is what's called the implicit function theorem. I will talk about it if somebody asks, but I'm not going to ever test you on this class. So all you need to know is you can rely on those two theorems to back out the slopes. Okay. All right. So second question. The second question, actually somebody here mentioned it to me. He was had a lot of foresight. So anyways, the second question asks the following. Take a commodity trade perspective of the current account and suppose restrictions on import volumes do have an effect on values. A government imposes a tariff on all imports. Use the AA and DD model to analyze the effect this measure would have on the economy. Consider both temporary and permanent. So the analysis is actually trivial if you just think about it as a tax, right? But that's assuming that a tariff, in fact, works like a tax. If it does, okay? If it does, then the analysis has already been done for you. It's in the slides, okay? So you can do a increase in taxes and then do a temporary and permanent case, right? You get the crowding out effect when you do a tax cut still, right? But it's in the opposite direction. And then when you do a permanent case, in the analysis that was presented to you last week, you get, instead of a appreciation of the currency, you get a depreciation of the current depreciation of the home currency. So the analysis is trivial if you just think about it as a tax cut, tax increase. But as someone pointed out in this class, I forgot who, but if you think about it as a tariff on a specific input for production within the country, then it's a much different story, right? So here, right, if domestic goods are poor substitutes, let's see. Yes, so you can think of it as a higher input costs rising. So if you think about manufacturing of cars and you depend on chips and suddenly you impose a tariff on those chips, then it's hard to find a good substitute, right? And it's most likely that this case is probably more true than this above case that I described earlier, right? So if you just think about tariffs like taxes, as I said, higher prices are only borne on domestic importers, and you could observe substitution towards domestic goods, right, which could actually increase output. Yes, but on the other hand, if it's not, all consumption based, then you can probably get the opposite effect. You can get a decrease in output as opposed to an increase in domestic output, right? So if I ever ask you a question like this, you just have to make logical sense. So someone brought this up to me, and yeah, I also thought about it too. So again, the idea is here is if tariffs are just specific to all goods, just consumables, for example, then obviously people will substitute away from foreign goods, right, for domestic goods, and there could be increase in domestic output. Done. But on the other hand, if it's a import of a intermediary good for production, then actually output could reduce, right? Which is what we're observing in mainland China when people use tariffs strategically to undermine economies, right? It's the same for Iran, it's the same for North Korea, same for China. These sanctions, right? And so you get a contraction in your economy as a result of these additional costs. All right. But in any case, if you walk through the same analysis for this as last week, the conclusions are, just the same, but in reverse. All right, comments, questions on tariffs. So questions on tariffs, it's tricky, right? It depends on the specific example, depends on the context, and the context will basically tell you everything, right? So if I ever ask you a very vague question, you should probably cite examples. It's probably the ideal thing to do. All right, so before we talk about this week's fixed exchange rate stuff, I'm gonna spend some time clarifying exchange rate pass-through condition. Okay, so it's called the exchange rate pass-through condition because it's the condition that's necessary to make a claim that changes in the spot exchange rate can ultimately have an impact on the change in output. There's a name associated to this exchange rate pass-through condition. It's called the Marshall-Lerner condition. And all it's saying is that the sensitivity of the current account with respect to Q is going to be positive. Okay. It's negative, that would mean, something you saw before, means the value effect dominates the trade flow effect, right? The volume effect. And we care about this condition because we want to know, as I said, we want to know the conditions in which fiscal and monetary policies can pass through the exchange rate and have an impact on output. And we've already derived it before, okay? But if I want to give you a more economic intuition for the derivation, that's what I'm going to do right now, okay? So, we all know how to take derivatives, assuming we know that. And we also know the derivative of the current account with respect to Q. We know the structure to some extent. Now, economists like to work with what's called elasticities, which just means is a fancy word for percent change with response to a percent change of some other variable. Okay, so what that means is like change in y over y divided by change in x over x. Right. So this is called an elasticity. Okay, elasticity of y with respect to x just means percent change in y when there's a percent change in x. Economists love to use these this way to characterize relationships, and that's what we're going to do. Okay, so we take the current account sensitivity, and we're going to replace all its parameters with elasticities. Okay, namely, we're going to assign two variables called eta. So this is a Greek letter eta. It looks like an N, but it's called eta. Eta is our elasticity of X percent change in exports with respect to a percent change in Q. Okay, and you can see it, right? It's a partial EX over EX, it's a percent change, divided by a change in Q with respect to Q. So it's a percent change, right? So percent change divided by percent change. Eta star is the elasticity of export with respect to change in Q, but for the foreign country. But note that the Q is still domestic, right? So it's the percent change in Q, but now it's EX star as opposed to just EX. All right, cool. So given these elasticities, we can now rearrange them to look like something we've seen before in this equation here, right? We know this equation. It has sensitivity EX with respect to Q and sensitivity of EX star with respect to Q. We can rearrange eta and eta star to look like the following very easily, right? We just divide both sides by their multiply and divide both sides by EX and partial EX and partial Q, right? So you can rearrange the terms to look like this. Once you've done that, we just substitute every time we see EX, partial EX over partial Q with eta EX over Q. That's it. Okay. And so the final equation we get looks like this. So let me make sure we're on the same page. So this is the equation we're working with. So you notice this, right? You notice this, you notice this, right? And now we're swapping these sensitivities of exports with now an elasticity times a ratio. Okay. I know you're asking why. Well, I'm going to tell you why soon. And it's supposed to give you some intuition. Okay. All right. So once you replace those partial derivatives with elasticities multiplied by ratio and set the condition that there is pass-through, that means greater than 0, we can then rearrange terms even more to look like this. Okay. So what is the intuition of this equation? This equation is saying that the elasticity when it comes to exports, domestic exports, has to exceed the cost of, or the elasticity of foreign exports abroad, right? So your sensitivity to changes in Q has to be stronger than the sensitivity of changes in foreign exports given our change in Q. Right? That's what it's saying. But there is a ratio term here that's supposed to have an amplification effect, right? You get what this is saying is that your pass-through is perhaps most strongest or most effective if you are a export-driven economy, right? So when you are like China, when you have big trade surpluses, you have tremendous pass-through when you control or manage your exchange rates. Right. On the other hand, if you have imports, that's very strong import-dependent countries, that means this ratio is very small. Pass-through is difficult, right? So it's not a good idea to try to use the exchange rates to affect output. So that's kind of the takeaway. So maybe let's say that again. So why are we working with elasticities? Because economists like these parameters. It's fine. Once we replace everything in the current account, the sensitivity of the current account with respect to Q equation, right, with elasticities, we ultimately get an expression that looks like this equation. And then setting it greater than equal to 0 states that there is pass-through from changing exchange rates on output. Okay. Once you have that condition imposed, we can rearrange terms to give ourselves a little bit more insight, and you get something that looks like this. This is saying that your country's change in exports with respect to a change in Q or exchange rates needs to exceed the sensitivity of the export sensitivity of the other country when Q changes. And it has to exceed more than 1. Okay. And your elasticity is amplified depending on whether your country is an import or export dependent country. Pass-through intuition is following. Pass-through is much easier if EX is very large, right, relative to IM. On the other hand, there is basically no reason to try to affect output through exchange rates if your import is ginormous, right? Because if imports is super big and this number is some negative number, this is a super small number, then you're always negative. And always negative number is always not going to be greater than 1, right? So no pass-through. So that's the Marshall-Lerner condition. Okay, so this condition needs to be satisfied to make all the type of analysis we did last week with flexible exchange rates. The reason is because we assume that changes in Q will have a positive effect on CA and have a positive effect on output and so forth. And if that doesn't work, and that means the Marshall-Lerner condition is broken, and we can't, then there's no point in actually doing using exchange rates as a way to affect output. All right. Comments, questions on the Marshall-Lerner condition? Now in its full, hopefully, complete view. All right, so what does the value effect look like? What does the volume effect look like? We can actually look at examples here. So the reason why Serbia is chosen is because it's very rare to actually find instances of external sudden changes in the exchange rates, right? Serbia is an instance in which we do have data in which their exchange rates changed. Fluctuations were sudden and unexpected. Okay, so when you have a sudden change in their exchange rates, and we follow how the current account evolves over time, that's what this graph is showing you. Okay, so this is CA on the y-axis, and this is months. Okay. So just to demonstrate that, yes, in fact, there is a scenario in which the value effect dominates the volume effect, and you can see it clearly within the first 3 months. So this is aggregating, this is averaging over several exchange rate shocks across time and looking at time 0 versus all the way up to a year. Okay, so these are therefore confidence interval bands. Okay, I believe 95% confidence interval bands. So what this, and then the dark black line is the mean. Okay, and so what this is showing you is that there is a dip, right? When there is an increase in E and therefore Q. And you see that value effect dipping, right? First 3 months, but after 3 months and up to 6 months, it becomes positive, right? Here. That's where the volume effect starts to dominate on average, the volume effect, in which there is exchange rate pass-through, right? A way for exchange rates to have an impact on output at the end. So all that stuff we did last week, we're like here, okay? We're assuming we're over here. We're past the very, very short term, few months, 6 months. We're talking about probably year beyond the year, okay? So this is called the J curve, which I will again explain later in the slides. All right, so that's all I want to talk about before going to this week's slide. So any comments on the Marshall-Lerner condition? Also on the homework assignments, problem set. Okay. So let's talk about managed and fixed exchange rate regimes. So last week, right? Last week we assumed that all economies in the world and all trading partners that we think about when we do the type of analysis we did last week, we assumed that every country adopted a unmanaged exchange rate policy, which means they don't specifically intervene in the FX market to give guidance on how the exchange rate should move over time. But today we're going to talk about specific countries that attempt to manipulate and control where this exchange rate should flow or change over time. And my job is to give you a sample of what different ways to manage or control your exchange rates. If this is in fact a thing that countries do, and they do, we have to introduce a new schedule to the AANDD diagram called the XX schedule. Okay, so that's just a way to say, a fancy way to say, there is a current account target. So if there's a current account target, that means that these countries have incentives to manage their exchange rate, their domestic currency value. So China, it doesn't look like they do, but they in fact have very forward guidance over how that currency should evolve over time. And the reason is because they do have GDP targets for a long time. Maybe not until recently. They think they dropped it, but I'm sure they secretly do have some targets. Singapore also has a managed exchange rate. Hong Kong obviously does. It's a peg. It's basically a peg, but there's other countries that do as well. Saudi Arabia has a peg to the US dollar. El Salvador has a peg to the US dollar. Yeah, so there's heterogeneity in the world in which people use to maintain their currency and satisfy their internal and external governance, right? Full employment and price stability. Okay. So our objective is to show you the pros and cons of having a managed exchange rate. The key takeaway is that sometimes if you're a growing economy, it's a good idea to have a pegged exchange rate because it gives your country credibility. You're basically borrowing another country's credibility so that you don't recklessly spend money and devalue your currency just to pay off your debts, like Argentina, Venezuela, and Zimbabwe. Right? You must have seen the Zimbabwe $1 trillion, right? It's worth nothing. It's worth less than toilet paper. So if you do that, then nobody believes in your currency. And then what happens? You have to adopt another country's currency, which they do. Zimbabwe, I believe, has dollarized their currency, meaning the dollar is the de facto currency. Okay. So let's talk about. So I already wrote some of this down. So I already wrote it down. So maybe I just talk about it. So here are some exchange rate policies. Okay, so maybe I'll clear it and then just write it again. Currency board arrangement just means that, so let's start with Hong Kong, okay. Hong Kong technically has what's called a currency board arrangement. That just means that there is a body organization that decides how to manage their currency. But in Hong Kong, it's more or less a peg, interpreted as a peg. So if you want examples of a currency board arrangement, you can think about Brunei, as well as Hong Kong. So Brunei, like Hong Kong, it's not a true peg, but their currency is very intimately linked with the Singapore dollar. Hong Kong, again, is not a true peg because they have a band, but it's very, very intimately linked with the US dollar. All right, so this is what Hong Kong is. So I'm mentioning it first. All right, so that's kind of like the middle ground, right? You don't want to have a full currency. You don't want to have a true independent currency. At the same time, you don't want to be free floating, and so you have something in the middle. It's a currency that you can decide to do. You can decide to change the way it is sometime in the future, but for now, it's maintained. It's quasi pegged to another currency. It has some sort of interval bands, perhaps. That's the middle ground. Okay. At one extreme is when you completely give up having an independent separate currency, and that is called no separate legal tender. There's a word. There's a popular word. It's called dollarization. Okay, it's called dollarization because U.S. dollar is the reserve currency, and they just, instead of creating their own currency, they just borrow their currency, and that's the currency that's being circulated. To some extent, Macau is like this. You can bring Hong Kong dollar over to Macau and just spend it. So it's almost as if they're just borrowing Hong Kong's dollar. They do have their own currency. But I have no idea what their monetary policy is. Okay, I don't think they do anything. At least Hong Kong's currency board or Hong Kong Monetary Authority, they have a system in place that maintains a band around for the US dollar conversion with Hong Kong dollar. Okay, so countries that dollarize their currency are, as I said, El Salvador. So you may have heard El Salvador in the news recently because not only do they consider the US dollar as their current home currency, but they also adopted Bitcoin as their home currency. So if you have Bitcoin, you can go over there and try to spend it. You can try. Another country that dollarized their currency is Ecuador, and I just mentioned also Zimbabwe. Right. So Zimbabwe is the country that they create money to pay off existing debt, so their currency is worthless. And yeah, you can literally see the currency littered in the streets because it's literally worth less than toilet paper. Okay. And as a result, they have to depend on something a little bit more trustworthy, the US dollar. All right, conventional peg means that there is a fixed exchange rate, just like the dollar peg. Okay, conventional peg, that's what it means. So a country that has a conventional peg is Saudi Arabia. And I said it's the US dollar. I don't have the number off the top of my head, but you can Google it. All right, so let's talk about more middle ground stuff. Pegged exchange rate with horizontal bands. So this is something like Hong Kong, but the band is kind of arbitrary. I'm not exactly sure what it is, but a country that's cited as an example is a country called Tonga. So what they do is actually they say that it's 10%, so X% around a target. So they announce that, and that's what they do, right? That's what they do until they change their policy in the future. So an example would be, suppose their currencies, we have a target exchange rate of 1-for-1, but then plus or minus 5%, right? That's what a pegged exchange rate with horizontal bands means. So maybe I'll also write Hong Kong, also Hong Kong to some extent, but there's no target. Okay, so Hong Kong is different because they don't have they have a band, but there's no target. Okay, so you can think about it. So it's close. So takeaway, big picture, right? Big picture. There are extremes here, right? You can be like the developed countries. You have your own floating currency. It's fully independent and it fluctuates depending on demand and supply based on speculation or based on demand and supply of goods and services, right? So that's like that's a free floating, right? So this is like last week stuff, right? All currencies fluctuate, no maintenance. At the other extreme, you get peg, right? A very deterministic exchange rate between currencies, so zero uncertainty what that value exchange rate should be, and the central bank, all it does is just maintain that, but they can do anything else. But of course, there's a cloud of different policies in between, right? You think about Hong Kong, Brunei, Singapore, so forth, that have something that's in between, right? Free floating and peg. All right, so let's talk about some others. A crawling peg is a peg, but it has a step path over time. So the example so let me give you what it looks like. So perhaps over time, for like 2 years, it has a fixed exchange rate at this level. And then maybe they announce, say after a few years, we're going to change the exchange rate up here and then up here and so forth. They may change it down here. But the idea is that the peg has there's an announced future peg in the future, right? That's going to change in the future. So you may hold a peg for a few years and then you change the peg after those years and so forth, but it's pre-announced. So everybody knows when it's going to happen. So a country that does this is Nicaragua. Okay. So crawling peg it's a peg, but the peg changes because the maintenance of that peg changes over time. Okay, at a different value. And it's pre-announced. All right, exchange rate within crawling bands. This is China. So like a crawling peg, rather than a fixed point, they allow the currency to fluctuate within a band. So that would be like someone draw X's to indicate values, and then maybe sometime in the future it changes. Like, all right, maybe I won't draw X's, I'll draw lines. Okay. So imagine currency value have volatility, but it's fluctuating within this band, but then the band is announced to be higher, right? Then it just fluctuates within that band and so forth, right? So it looks like it's organic, but in fact, there's a lot of maintenance around it. So it's not a true peg because there's a little bit of flexible wiggle room, right? And that's what China pre-announces to everybody. Okay, next one, managed floating with no pre-announced path. This is like South Korea and Thailand. So what this means is that they do have an ulterior motive for maintaining the peg. So in this case, these countries are inflation targeting, and they believe that intervening in the FX market is one way to maintain inflation, and so that's how they maintain it. But there's no commitment to any sort of path or bands or whatever. But they do have a secondary condition that may be related to how they maintain the peg or the path. And then lastly, this is every other country you can imagine that's the Western world. So this is like US, UK, Canada, Australia, New Zealand, Euro, EU. Yeah, dot. Japan, I guess. Just means that they don't rely on exchange rate manipulation to satisfy any sort of internal governance objectives, right? But it's clear that Hong Kong and Singapore have a motive, right, for having such an arrangement. They want price stability so that they can be a center for capital accumulation and investments. There's a reason for why they want that stability, but there's a sacrifice, right? The sacrifice is these countries and cities don't have monetary policy, as you will see. Okay. This makes sense from China's perspective because they do have GDP targets. If they do have GDP targets, then they will use the exchange rate to hit those current account targets to stimulate growth. Whereas these developed countries, they prefer to have full control over their own interest rates to stimulate the economy. And that's their choice. But there's a trade-off, as you will see. They sacrifice stability for flexibility. And they obviously do have more tools at their disposal, but the cost is that they have to face more uncertainty and volatility. All right. Comments, questions on the space of FX rate management. So again, the takeaway is the following, right? I kind of wrote this graph here. There are extremes in which you can manage your currency. You can not manage at all. That's here, right? And then you can fully manage, which is a strict peg. There are pros and cons, right, to choose between here and here. Mostly between having flexibility in monetary policy versus price stability, right? That's the trade-off. And obviously, you won't choose an extreme. Most countries will choose something that's in between. Okay, and there's many different ways to commit to a middle road, right? As we've seen with the currency board in Hong Kong, with crawling pegs and crawling bands and so forth. There's many ways to do it. All right. So I talked about this already, the Marshall-Lerner condition. So I gave you the mathematical reason why there may not be pass-through from changes in E or therefore Q, the current account, right? As long as that sensitivity, elasticities, the combination of elasticities are satisfied greater than 1, then you get exchange rate pass-through. But I didn't really talk about the economics, right? So let me give you some reasons why there may not be complete pass-through from exchange rates to output. And this is kind of relevant to what has been going on since the COVID-19. So a lot of people were confused why there was not a stronger reaction in price levels early on in the COVID-19 pandemic, when all countries kind of coordinatedly increased their money supply crazily, right? So I'm going to give you some explanations, but these explanations don't fully, of course, explain what happened during the COVID-19 pandemic. So the first explanation I pointed out here is that the pricing to market by wholesalers and retailers, those prices may be monopolistic. So the idea here is that if you have wholesalers and retailers that are basically monopolists, then that means that they've already they already set prices in such a way that maximize their profits. And if there are increases in input costs, that doesn't change the price in which they set, right? Because they've already set the prices to extract all value from consumers. All the surplus is extracted from consumers, so that the company retains all the income, all the profits they can. And if they have a sudden increase in price levels, input costs, for example, either through exchange rates or whatever, that's not going to change prices, right? Because they are monopolists. So this may be hard to comprehend if you don't have a background in the micro econ. But the idea here again is, if I can set prices and force my consumers to be price takers, I've already set the prices at a point in which if I change it, I will lose money. So if I have an increase in input costs, that's not going to change what I set the price to be. So no change in prices. Does that make sense? So I can, if I'm a monopolist, so monopolies. Another word, monopolies mean specifically they have pricing power. Okay, if you have absolute pricing power, that means you've set prices in such a way to extract all value from everyone. Okay, and if there was a change in costs in terms of input prices, for example, that's not going to change the price I'm setting, because I've already set it to extract as much possible value from everyone, from consumers. Okay, so pricing power means already set prices to extract most value from customers. And so if they experience a sudden exchange rate shock, that's not going to have any impact on prices, right? It's not going to pass through. They're not going to boost production. They're not going to increase quantities, whatever. They're not going to do it because they've already set quantity and price to maximize as much value as possible. Okay, so that's one possible reason. So this is a industrial organization explanation. Okay, so that's the proper terminology. All right. Another reason why there might be incomplete pass-through is domestic distribution costs. The example I can best think of is like plutonium, okay, weapons. No matter, even if there is a price exchange rate shock or price shock through exchange rates, that's not going to change the cost. That's not going to impact the distribution cost of importing, exporting weapons, okay, or plutonium, because they're illegal, or there may be other organizations that tries to block me from getting it anyway. Okay, so for these types of goods, you may not see a pass-through, obviously, right? Like plutonium and weapons. So despite changes in relative prices through Q and through E, you're not going to see a change in import volume because there are these costs, these implicit costs from importing, exporting weapons. Okay. All right. Lastly, and it's kind of related to this question here, right? If you are a monopolist, or it's a competition explanation. So if you try to pass on additional costs onto your consumers or whatever because of changes in Q, that may actually lead to a loss of customers to your competitors. So sometimes you don't, as a company, you don't want to change quantity or price given a change in Q, because that may lead to an outcome, worse outcome for you, because you're not as competitive anymore, right? So you'd rather take on that loss now and maybe for a period of time, as opposed to cutting costs, which could actually lead to a long run bad outcome, right? In which you may have to exit or go bankrupt, right? So you endure for the short term. All right. So this last bullet point is mostly microeconomic explanations for why there may not be a pass-through through changes in Q through the current account and through output, right? But the macro mechanisms is clear, right? Change in Q means changes in relative price levels for average goods and services between countries. That's going to change import, export incentives and so forth, and leads to output or cutting out output, etc. That's the macro big picture mechanism. But there are micro reasons why that may not be possible, right? Number one would be monopoly power, in which people don't want to change price or quantity because they've already been extracting as much value as they can from everybody. Because there are distribution costs, such as, sensitive goods and services, such as weapons. And lastly, because changing price and output of goods being exported could actually lead to a worse outcome than if you did in the short run, because you might be out competed, right? You may just be you may lose the competition. So you'd rather just keep your customers and operate at a loss in the medium term, hopefully recover after the shock, right? After the change in Q. Right. So it's good to know the pros and the different viewpoints, okay, of how this assumption can break, right? Macro is quite simple, right? As long as Marshall-Lerner condition is satisfied, done, right? But there are microeconomic reasons why it may not work, and here are a few. Okay, so if we want to talk about if we agree that there may be some good reason why a country want to manage or maintain their exchange rates, then you have to believe that these countries have perhaps a current account target. Okay. And the example I always give is, again, China, right? They must have an export relative to import target, because once if they meet that, they may therefore can satisfy their GDP targets, right? GDP growth targets. So in order to do that, we have to introduce a new equation, in the A and DD schedule. And this is going to be called the XX schedule. It's called X because it stands for exports, So it's very simple. It's just a fixed number. So CA target is like an actual number. Think about it like $10 billion, okay, or 10 billion Chinese yuan. And we're saying it takes a function of Q and Y, and we know that Q, of course, is equal to EP star over P. And so what we're trying to do is plot the trade-off between E and Y for a fixed number, right? So given this current account function. So different combinations of E and Y that gives us some fixed number. So CA target is just some arbitrary number that a country has. Okay. So it's not an equilibrium equation, right? It's not an equilibrium equation. It's just saying that $100 equals, 99 plus 1, right? That's possible. Or 50 plus 50, right? Different combinations gives you the same fixed number of 100. So every country has a different nominal value, current account target. Okay. On the graph, it's going to be upward sloping, obviously, right? Because a depreciation of nominal exchange rate would cause a depreciation of real exchange rate, and therefore the current account will rise, right? So as E increases, Q increases, and current account increases, and then therefore Y increases, right? But the slope, it slopes up less steeply than the DD schedule because it's missing that consumption part of aggregate demand. So what does that mean? So what this is saying is that when you increase income by a certain amount, in the current account function, all that increase in income is going to go, all that change in E is going to go towards increasing output, okay? Yes, through CA. But for the DD schedule, there is another term, right? It's the consumption term. So some of that consumption is not going to go towards exports. It's going to have to go towards domestic consumption. And that's why relative to the schedule, it's less steep. So maybe I'll show you what that means with this picture here, okay? So let me tell you what I did first. I first drew the DD schedule along with an A schedule. And we have an intersection point. Let's assume that's our starting point. And let's assume that this country has satisfied or hit their current account target, which is this line here, okay? XX schedule. So why is it less sloping? Well, you can analyze this in this fashion. Maybe just draw a straight line. Here versus here, and then versus here versus here. And you can see the change in Y, right? So the reason why the output is lower, right, is because of the consumption part, which is not driving exports, right? Whereas here, the change in E has larger impact on output for the x-axis curve because all the change in E is going into this current account, right? There's no consumption part. And so the change in Y here is bigger than the change in Y here. Okay, so that's why the XX schedule is flatter compared to the DD schedule because of that consumption part. Yeah. Okay. Does that make sense? So all the change in Q goes towards changing the current account and leads to output, right? That's why it's flatter. Whereas under the DD curve, when you have changing Q, changing output, some of that extra income is going to go towards consumption. And that's why your output is not going to be used towards creating goods and services to be exported, right? It's going to be used for consumption. And so the DD schedule has a stronger slope, more positive slope. All right, so that's the shape. All right. Now let me use a different color because I have too much stuff here. So the point of this graph is to talk about a question I may kind of ask in the final exam. So if I said the country were to shift the XX curve to a new target, an example would be here. So suppose I drew a line. Let me just draw a solid line. Draw a solid line here. A question I would be asked, what can this country do, fiscal or monetary policy, to hit that new target, right? So that means that the final equilibrium XX and AA schedule, it must intersect on the XX schedule, right? That's how you hit the target. Does it make sense? So this is a good question, right? So let's say China decides to change its current account output, current account target, I guess, higher. What sorts of monetary or fiscal policies can they execute to meet or satisfy that new current account target? So I drew like these points here to kind of give you an idea of how to hit certain targets, right? Change in targets. So here, relative to this point, you can easily hit this if you decide to conduct expansionary monetary policy, right? Especially a temporary one. So as long as you hit this target here, I mean, if you as long as you increase the A schedule up to this point here, you can then meet the XX prime target, the new XX prime target, right? So this is just something to think about, right? If the XX curve is even higher, right, something like this, then you can do permanent monetary policy expansion. Well, if it's down here, right, you can do temporary fiscal policy, or if it's super down, then you may have to shift. You have to shift more curves, right? But things to think about. So hopefully these points make sense, right? So this point is just the crowding out effect, right, from my fiscal policy. This point here is if you do permanent fiscal policy, but it's completely ineffective, right? So your currency appreciates immediately in the short run and long run, but at least if your current account target is lower than before, you can now hit it. That doesn't make much sense to you now, but maybe I ask you, well, what if the target is here, right? Then you can conduct permanent fiscal contraction. Then you can hit it, right? That's something to think about, right? So I think shifting the current account target should be obvious, right? So if it's higher, then right, you fix one variable, E or Y, and then you say, well, how much does Y have to increase? Right? Or I guess if it's up and down. So you can think of it in two ways. You can move it up and down or move it left and right. It depends on which E, depends if you hold E or Y fixed, but that's how you shift the curve. So I think that's obvious, right? So yeah. So if you want to think about it as up and down, you would just fix Y. Or you fix Y. And let's say it's like instead of $5 billion, it's $10 million. Sorry, $10 billion. So obviously, current account target is larger than before. You're fixing Y, so E has to be higher. Yeah, higher. So then this XX curve shifts up. Yeah, that's how you shift the XX curve. You don't have to fix Y, you can fix E and do the same analysis. Okay, so you can, when I say XX curve shifting up and down, left and right, it depends which variable you're holding constant, but it's the same idea. Okay, so just work through the visual logic yourself, and then again, think about how you can use all the policies that was talked about last week to hit the changes in the XX curve. All right. I hope I didn't go too fast, but I think I hope the explanation of why the x-axis curve is flatter is clear, right? It's clear because I mean it's different because there's no consumption part. Yeah, that's why it's flatter. That's key point number one. Key point number two, x schedule can shift left and right and up and down just like the DD schedule. The x-axis curve is just a fixed constant value that can change. So the example I'll give you is like $10 billion change to $100 billion. Yes. And therefore the x-axis curve will shift left or up, right? Or right or down for E and Y. And then you can think about how to shift the X and DD curves to satisfy the target, right? You can change AA, you can change DD, combination of fiscal and monetary policies to hit that XX curve. I mean, I leave it to you, okay, to experiment how to do these shifts to satisfy changes in the XX schedule. I think is ultimately an interesting exercise. So the Marshall-Lerner condition equation I've already explained, so I'm going to skip. And this is the J curve I've already mentioned before, but I'll give you some theoretical graph here. So the example I gave you was Serbia. The thought experiment is the following. Based on this equation here, this equation, I guess I don't have it. Oh, yeah, based on this equation here, the impact on the change in Q on the current account can fluctuate over time. And the idea here is that in the short run, export channels are turned off, whereas all we're thinking about is the price that you pay for imports, right? If you think about just the price that you pay for imports, when you have an exchange rate shock, then the price of those imports are rising because Q is increasing. In which case, the current account change will decline. So this is the theoretical explanation why value effect dominates the value effect, because those export channels are turned off. But over time, we expect the Marshall-Lerner condition to be satisfied, in which the volume effect will supersede the value effect. So that's at this point here. So again, for all the analysis we did last week and the weeks before, we're always assuming that we're in this space here, okay, in which The value effect is trivial compared to the size and magnitude of those trade flow channels. All right, before I go into the next few slides, let me think if we have enough time. All right, so let me talk about sterilization first before we take a break. Okay. So first of all, any questions on current account targeting, managed exchange rates? We'll talk about pros and cons. We talked a little bit about pros and cons already, but we'll talk about specifically scenarios why fixed exchange rates are pros very soon. But hopefully you know how to draw the x schedule on the E versus Y graph. You know how to shift the XX curve. And if the XX curve does shift, you should convince yourself that you know how to shift the AA and DD schedules to satisfy or find an equilibrium that is on the XX schedule. And you have to be able to explain how that's achieved. Okay. All right, so let me talk about sterilization before we take a break. So sterilization is a monetary policy tool to keep the money supply constant, but change the composition of the balance sheet. Yeah, that's basically it. They want to change the composition of its balance sheet while maintaining the money supply level. Why do you want to do that? Well, maybe you don't want to have an impact on money supply and therefore impact inflation, but maybe changing the composition of your balance sheet have some sort of secondary effects on the FX market. So that's what we're going to talk about. So let me explain to you how things are sterilized. What it looks like on the balance sheet, okay? So consider the following balance sheet. So this is very simple balance sheet. I'm going to throw this away, okay? So I know this is, so here we just consider the following, okay? So assets equals liabilities. There's three types of assets: foreign assets, domestic assets, and then other assets, monetary base, and then any difference is considered net worth. All right, so that's simple enough, but to make things even more simple, I'm just going to drop these. Okay, so let's consider an even simpler one. Okay, assets equal liabilities, and then we have foreign and domestic assets, and then everything is financed through money, cash. So what does sterilization looks like? Sterilization literally means that we want to change the composition. So for example, maybe I want to increase the size of my foreign asset holdings, but by doing so, my entire portfolio has to expand, right? But let's say I don't want to change the monetary base. So that means that I have to find some way to reduce the size of my domestic asset holdings, right? And so what that means is that what that means verbally is that my foreign asset purchase is sterilized by a domestic asset sale, okay? Which means that keeps my monetary base constant. So let's talk about exactly the steps of how this is done. So what I want to do is I want to buy WCB. So how is it done? I'm going to print money to buy foreign currency and then use that to, and that's going to increase MS, right? Money supply. And then I'm going to use that to buy, I'm going to continue this chain of logic, sorry. I'm going to use that to buy WCB, right? And then to sterilize it, I'm going to sell the CB, base capital. Which leads to a decrease in, or just decrease in MS. Right? So the net effect is MS star, actually MS star decrease, right? So this is kind of a takeaway. So the steps. I want to buy foreign assets. So what do? I can print some currency, use it to buy foreign currency. And that means I'm increasing the monetary base, right? Once I purchase the foreign asset, I have to sterilize it to undo this increase in money supply. So once I buy it, I'm going to sell domestic currency. So that means I'm shrinking this, but at the same time, I'm removing domestic currency from the system. Yeah, because somebody has to pay me for the asset, right? So then that reverses, right? That reverses the increase in money supply. So in the end, no change in our own monetary base, but there's a side effect, right? Which may be relevant. So why is this important? Well, this is important when um, when we have sovereign debt that have different types of risk profiles between two countries. Um, the idea is the following: if you have more assets, more debt in circulation, then there's more interest payments to service, and therefore the likelihood of your defaulting is actually higher than before. And so if you change the if you in this case here, even though I haven't touched money supply because it's sterilized, there's actually now more domestic bonds being circulated than before. So more interest payments to serve and so forth. In which case, your likelihood of default could be higher if you have credit worthiness uncertainty, right? And this is where the augmentation of UIP is going to come in. Okay, so before we get to what's called relative risk premia augmentation, let's take a 10-minute break. In the meantime, if you have questions, you can ask me. Otherwise, please help yourself to the snacks. I know there's no eating policy, but if you don't tell anybody, I won't say anything either. Okay. All right, I'll talk to you guys in 10 minutes. All right, let's finish up. All right, so relative risk premium is just a way to augment our UIP equation with another risk factor. So just like CAPM, and maybe you've heard of Pharma French, we can do the same thing by introducing more risk factors as part of the linear equation. So what we do now is not only is interest rate differential a function of expected depreciation of the home currency, it's now a function also of this Greek character rho. So rho is supposed to represent the relative risk riskiness of sovereign debt between two countries. So maybe it's clear if you think of rho for now as like a positive number. So think of rho here as a positive number. What does that mean? It means that domestic deposit returns needs an additional risk premium so that R is equivalent to R star plus expected depreciation home currency. If these two countries have relatively riskiness in terms of their debt default, then rho is 0. But when rho is positive, a carry trader or investor would need additional returns on top of just base R, right? It needs some other additional risk, another additional return to offset that additional risk. That's what rho is if it is positive, okay? So remember, it's relative. It's not a nominal, it's not a fixed level. It's the relative level between two countries. So if we're comparing, for example, US to Canada, rho would be very close to 0, and therefore this model has no meaning. But if we're comparing US with China, in which China's credit history is obviously short in the US and therefore has worse credit in the US, and let's just suppose China is the home country, then rho most likely will be positive. Okay, so it's just, you can think of it as like relative credit worthiness between countries. So hopefully that's clear. So again, rho is a parameter that represents additional returns in order to make R equals R star plus expected depreciation of home currency. And that additional return represents risk, okay? Extra risks to offset the difference in relative default risk of the country. Okay, so that's how you should think of it for when it's positive, but it's equally valid if rho is negative, right? So suppose US is the home country and China is the foreign country, then rho would be most likely negative, right? All right, so just based on that description, you can kind of tell where I'm going and when I parameterize rho, right? We talked about sterilization. So if a country can change the composition of what is privately held in terms of sovereign debt, then rho can change as well, right? And therefore impact the UIP equation. So let's go ahead and try to parameterize rho. Okay, so rho is going to be a function of private holdings of domestic bonds, okay? But you can also think of it as foreign bonds, but just for simplicity, just think of it as domestic bonds. Private holdings of domestic bonds means holdings of bonds that's not being held by the Federal Reserve or the central bank. Okay, so just take US for simplicity. Federal Reserve, if it holds more bonds, more US treasuries, then bond priv goes down. If they decide to liquidate their treasury holdings, bond priv would increase. Okay. If all else equal, okay, right? All else equal, if there's more bond U.S. Treasury floating around compared to Chinese bonds before, okay, so we're just suddenly, if China didn't increase their issuance of bonds, but there's suddenly now a more supply of bonds being circulated, then you can think of it as the credit worthiness of US is most likely undermined because they have more interest payments to service. In which case, that's going to impact Rho, right? That's going to change Rho in a certain direction. So that's the idea. All right, bond priv can be decomposed into two parts. So private holdings can be therefore defined as total issuance of bonds, subtracting what's being held by the central bank. Right. So now it's clear what parameter the central bank can change, and if they change that parameter, they're going to change B priv. Correct. So if rho is a parameter, if rho is a function of B priv, then it can be written as rho as a function of B total minus BCB, which represents domestic bond holdings of the central bank. And therefore, the adjusted UIP equation that we'll be working with and those situations in which two countries have different relative risk premias is going to look like the following. R equals R star plus expected depreciation of the domestic currency plus rho, which is a function of total domestic bond issuance minus total domestic bond holdings of the central bank. And so if the central bank decides to decrease its holdings, that's ultimately going to increase its private holdings of domestic debt. And therefore, that's going to increase rho, right? Because if more people are holding more debt, then all else equal, it means we have perhaps more creditors than before, and therefore that's going to undermine our credit worthiness, and therefore investors may demand additional risk on top of R to offset that risk, right? So that's why it's called a risk premium, because it's extra risk that requires extra returns to offset. And so if a country has more relative risk than before, you can think of UIP being violated like this, right? What's going to happen to E then? E has to move in a way that restores parity. That's only possible if the entire right-hand side decreases, and the only way it can decrease is if the nominal exchange rate increases, right? So you're going to experience a devaluation of your currency if you have a larger relative risk premium than before, right? Again, the idea is here that what's triggering the additional risk premium is because there's more creditors you have to service, and as a result, the deposit returns is insufficient to offset the risk premium, and therefore it has to come from the additional return has to come from the devaluation of your currency today, right? Through E. All right, so why is this interesting? Well, in combination with a sterilized intervention, it seems like we can accomplish exchange rate management without changing money supply now, right, under this equation. All we have to do is have enough domestic or foreign assets to sell or buy or whatever. Then we can change rho in such a direction that allows us to change E without changing MS, right? Pretty cool. You don't have to change MS if you have relative risk. Again, to summarize, you don't have to change money supply under this model to get a change in E. All you need to do is change the relative risk premium. Then it will automatically change the UIP equation, which will allow you to change the spot exchange rate and therefore have an effect on output and so forth. You don't have to change money supply. So it's another way to change Q, right? Another way to change Q. So equally important that, again, it's relative risk premium means that it's the relative supply of your home central bank's bonds relative to the relative change in supply of the foreign supply of bonds. So if they change their supply, that could change, I mean, private holdings, that could change the relative risk premium. I'm only parameterizing rho with domestic bonds, but you can easily see how changing the supply of your trading partners privately held debt, that could change rho as well, right? So just be aware that I'm only parameterizing in terms of domestic bonds because we typically think of monetary policy from changing BCB, right, instead of B star CB or WCB, sorry. All right. This is the what is this? All right, so what does that look like graphically? So maybe I just start over with this. I'm going to do it fast because I'm sure you've seen it. I'm sure you've seen this graph way too many times already. So this is our starting point, just like before. So what's going on with UIP, right? So UIP now R equals star plus we had E over E minus 1, and now we have plus rho, but now it's B TOT minus B CB, right? So what I described to you was a sterilized intervention of a foreign asset acquisition, but a sale of domestic bonds. So it's a change in holdings, central bank holdings, in which we're selling domestic bond holdings, right? So we have this parameter decreasing, but because it's also a purchase, no change, right? This doesn't change, no change, right? Because it's sterilized. What has changed is BCB goes down because they sold domestic debt. That means total private holdings of domestic debt increases. So this entire term goes up, which means rho goes up, which means following, right? And the only way to restore equilibrium or parity is if E, right? E has to increase, right? So E has to increase to restore parity. So what does it look like? It looks like the UIP curve is shifted up, right? So this is for E prime. Okay. I'm just gonna write here. E prime and E naught. Okay. And no change. That's the key takeaway. There's no change in money supply yet. We are able to devalue our currency. Right. This is actually fantastic, right? It seems like no side effects. But of course, what is rho? How do you calculate it? That's another story. But the idea here is that rho is a representation of different types of risk between government debts between countries, right? So that's why it's called imperfect substitutability. If two countries' bonds are perfectly substitute, meaning their risk are basically the same, then rho is zero, and it doesn't matter. But because creditworthiness differs between combinations of countries' trading partners, rho is going to be non-zero, in which case there's imperfect substitution because their risk profiles are different, riskiness is different, and as a result, you can take that to your advantage, right? And conduct these kind of sterilized intervention, in which money supply doesn't change, yet UIP is affected and you have a change in E as a result. Right. Comments, questions? So big picture, we started with everything being basically laissez-faire. Everybody adopts a they don't really manage their exchange rates, and we talked about monetary and fiscal policy. Now today we transition to why they want to move away from a laissez-faire style exchange rate system. People want to, the reasons because, well, first of all, imperfect asset substitutability, and also situations in which a fixed exchange rate may actually be beneficial for you, okay, which we'll talk about soon. All right. All right. So next part, as we'll talk about how to use fixed exchange rates to stabilize your economy when you're in trouble. Okay. So think about Hong Kong. How do we leverage the fact that we have a pegged exchange rate to counteract a economic recession? Right. That's kind of what you should be asking yourself. How does Hong Kong operate, conduct, address economic recessions when they have a managed exchange rate? All right, let's go ahead and talk about that. So let's see. So let's go on to a generalization here. So rather than be very, very precise, I'm just going to do very broad strokes on what a fixed exchange rate means. We're just going to take fixed exchange rate to just means a literal peg. Okay. So under the UIP equation, we all know what that means when there's a literal fixed peg. That means this term is zero, right? In which case we must have interest rates being the same. And because E hat E minus E is zero, that means spot exchange rate today must be equal to the expected spot exchange rate in the future, which is another way of saying E is constant. So if a city or country decides to commit to a pegged exchange rate, that means that this must be true forever, okay? And therefore, the central bank has only one function, which is to maintain the peg at all costs. If you conduct monetary policy, it will actually change the peg. And so Hong Kong has no monetary policy, essentially. And whenever its pegged currency changes interest rates, Hong Kong must follow. Otherwise, it's going to be very, very difficult to maintain the peg, as I'll explain soon. Okay, so let's go ahead and do an example. Let's do a positive output shock. Yeah, let's do a positive output shock. Let's clear this. So positive output shock is a change in Y, okay? I'm gonna do it fast because I'm afraid I might run out of time, but I think you guys can keep up. So positive output shock is an outward shift in the liquidity preference curve. Agree? Because it's L R Y, right? So if Y shifts out, then you must have higher interest rates, specifically here. Now, this is a big problem if you have a pegged exchange rate. So suppose we have our exchange rate initially pegged here. So let's call this E bar, okay? So E naught is equal to E bar, and that's country has committed to setting E to E bar forever. and suddenly there's an output shock. If the central bank does nothing, your exchange rate is going to be much lower. You're going to have an appreciation of the currency. That's a no-no, right? You can't have that. And so what must happen is the central bank must utilize money supply somehow, right? To restore back to this interest rate here, right? So there must be a monetary expansion to lower interest rates back to R so that you can restore back to its E bar level. Of course, if you have assets, imperfect asset substitutability, which we haven't assumed here, you can shift the UIP curve, but that's something to think about, right? There's another way to restore the peg, yeah, through imperfect asset substitutability, but we haven't assumed that. We're just assuming UIP, vanilla UIP. So if that's the case, if there's an output shock, there must be a strengthening of our currency because interest rates are higher. That can't be true. So under a pegged exchange rate, monetary policy must be fully dedicated to maintaining the peg, and therefore they must expand money supply to reduce interest rates back to R so that the peg can be stable at E bar. So it's clear, right? It should be clear that for pegged exchange rates, monetary policy must be used at all times to maintain the peg. So this scenario, we have a case in which we have an output shock. But let's assume that rather than reacting to an output shock, maybe the central bank wants to stimulate the economy through monetary policy. And I think it's obvious what's going to happen, right? So let's go ahead and just talk about it graphically first. So rather than redraw it, I'm just going to show you the graph here. So this is the AA and DD schedule. We have E on the y-axis and output on the x-axis. We have a starting equilibrium point, and the thought experiment is to suppose a country that presumably have a pegged exchange rate decides to, okay, I want to effect output through monetary expansion. They try to do it, increasing the AA schedule upward to AA prime, but they run into a problem, right? Because if you do, you're going to have a exaggerated, you're going to be a very, very, very depreciated spot exchange rate as a result, right? And that's a no-no, right? You can't, because you've told everybody that you're going to maintain the spot exchange rate at this level. So that expansion must be reversed immediately. Okay, you cannot do it, obviously. So to summarize, okay, suppose you want to do a monetary expansion to effect output that requires you to purchase domestic assets to increase money supply, which would lower interest rates, and therefore spot exchange rate must increase. You must have depreciation. But that's can't do it, okay, right? Because E changes. And so you actually have to undo the whole thing by must be offset by a sale of something else. Even though you're buying your own stuff, you have to undo it completely by buying something else. It could be domestic bonds or foreign assets. Either way, you're withdrawing. You're undoing the change in money supply. You can't have it. You can't have it. You can't have it both ways. Okay. So as I mentioned, right, you must have R equals R star. Our interest rates have to be the same across those two countries in which the exchange rate is defined. Otherwise, the peg is broken, right? Otherwise, the peg is broken. All right, but things look better for fiscal policy. So remember I told you about the crowding out effect, right? The idea here is when you have a tax cut or government spending, that's going to strengthen your currency, and that's actually going to undermine your output effect, like we learned from last week. But under a pegged exchange rate, because the country or state that's having the peg has to fulfill their claim to having a pegged exchange rate, they can actually hit that full potential of the fiscal policy because they have to maintain that peg. So let me tell you what I mean. So in this graph, again, starting with AA and DD schedules, this is our starting point here. We conduct temporary fiscal policy expansion. All else equal, if we do no other intervention, we're going to be here, right? And as we learned from last week, there's going to be a crowding out effect because as your currency gets stronger, that's going to undermine your output, right? When your currency gets stronger, that's going to undermine your output. So in reality, your full potential is here. That can't be realized if no other intervention. But under a fixed or pegged currency, you must maintain this E bar level, right? You must maintain this initial exchange rate level. So you must react to temporary fiscal expansion with also monetary policy expansion as well. So the AA schedule must also move when you do fiscal policy. So you have two actions at the same time. And when you do that, you get the full potential of the output effect because E bar is maintained constant, right? E bar didn't change. So there's no crowding out effect from the stimulus by CA, and there's no domestic currency appreciation anymore, right? We're not going from here to here. We're going from here to here because we're having two actions, a fiscal policy and a monetary policy. They work in conjunction. When they work in conjunction, you have a fixed, the exchange rate is maintained, right? Before the action and after the action. And you also reach the full potential of the output, right? You get the full horizontal distance, right? From this point to this point. So I don't want to walk through the shifting the curve. I think that's obvious, right? Just when G or T changes, DD curve shifts, right? And then when you do monetary expansion, AA curve shifts. And when those two things move together, it's possible to move them in conjunction so that the exchange rate stays constant. That's the takeaway. All right, so to summarize, under pegged exchange rate, monetary policy is given up. You can't use monetary policy to change money supply and therefore affect interest rates and therefore affect output, because doing so, you're deviating away from your promise of maintaining that fixed peg to everybody. Okay, so if you keep doing this, nobody's going to believe in your currency anymore. You lose credibility. So you have every incentive to maintain that peg. Okay, if you decide to commit to a pegged exchange rate. But the bright side of having a pegged exchange rate is that your fiscal policy now can achieve its full potential. But you have to use fiscal policy and monetary policy in conjunction to maintain the peg. But when you maintain the peg, you can achieve the full output effect from government spending or tax cuts. Okay, so this is kind of what Hong Kong and other countries do. So you typically use these two fiscal and monetary policies in conjunction with each other. And the reason is obvious. Well, let me tell you the reason why you want to maintain a peg. I mean, why you want to do these things together. If you don't, then in the case in which the Hong Kong dollar gets too weak, you have to sell off reserves. So so if you run out of reserves to sell, your currency must depeg. Okay, so that's a currency crisis. Okay. So typically you don't want to drain your reserves. You need a healthy amount of reserves, otherwise you won't be able to maintain the peg indefinitely. All right. So another way to use the peg to your advantage is through an announced change in your peg. So just because you commit to a peg doesn't mean you can't change its level. As long as you don't do it too frequently, it shouldn't be a big problem, because people will just think of it as a shift in the stage growth of your country. That's fine. But if you keep doing it, then you're going to lose all credibility. So this is a scenario in which, for example, if China decides to announce a currency devaluation that's unexpected, and as a result, that can actually allow you to boost your output. Okay. So maybe let me go walk you through what that looks like in pictures. Okay. So suppose this is like China. You have aggregate demand from aggregate demand, initial aggregate demand plotted here. Let me use. So this is your aggregate demand, right? Initial one. This is your initial aggregates. AA schedule, and this is your initial equilibrium. And suppose you have a more or less pegged exchange rate at 6 something right here. Okay. So one way to also effect output is to do a sudden announcement of a devaluation of your currency. So rather than maintaining the peg here, you say, well, I'm going to have it at E bar prime. So rather than 6, it's going to be 7. So just based on what I just told you, it looks very, very much like monetary expansion, right? Because we're just shifting the AA schedule from here to here. And we're shifting just enough to hit that E bar, right? The new E bar prime. So everything so far should just look precisely like monetary expansion. The only difference is the following, okay? The difference now is that DD and AA have to move in conjunction such that E bar is maintained in the long run too. So long run, short run analysis is very, very boring in fixed exchange rate regimes, right? Because in the end, long run, short run have to have E bar being constant, right? So here it's very boring, right? Temporary fiscal expansion, permanent fiscal expansion, doesn't really matter. You just have to make sure E bar is satisfied, right? That's the rule when you do the analysis. When you do long run, short run analysis, temporary, permanent fiscal expansion, whatever, E bar has to be satisfied in long run and short run. So you just make sure those things are maintained. Okay. Same thing here. E bar has jumped to E bar prime. Long run, short run analysis is making sure that E bar is satisfied. Okay, it has to be true. And so in the end, after prices has caught up to the change in money supply, the DD schedule can only shift so much such that E bar is satisfied. E bar prime is satisfied. So this is your short run answer, and this is your long run answer. So we're going from here to here in your analysis. All right. So why is devaluation, too much devaluation bad? So let me talk about a currency attack in this example here. So as I said, it's not really a problem if the currency you're pegging to gets weaker, because as it gets weaker, your job is therefore just to print more of your money, right? Because if their currency is getting weaker, you have to make it just as weak as before. So you just print money and then you buy their currency. Yes. So that's what Hong Kong does. Whenever whenever the Federal Reserve decides to conduct monetary expansion, they're printing tons of money. Hong Kong is just printing more Hong Kong dollars and using those Hong Kong dollars to buy those US dollars. It's accumulating its reserves. That's super good for us, okay? Super good. Problem only comes about if US decides to start increasing interest rates, right? If their currency gets stronger, our currency has to be just as strong, right? Because of the peg. So what do you have to do? You have to revalue the currency, and that requires to flood the market with US dollars, right? You have to flood it, liquidate your reserves to maintain the strength of the currency. So, but you can already see a problem already. Once we run out of reserves, we are forced to depeg, because you can't maintain it anymore. So current FX attack would look like the following, okay? So suppose you have a speculator, they're going to borrow 100 Hong Kong dollars, and then they're going to convert it to US dollars. So let's just assume the exchange rate is arbitrary E. And they want to conduct an FX attack. In other words, they want to try to weaken the Hong Kong dollar and force HKMA to deplete its reserves. Okay. Why would they do that? Well, because they want to be able to buy Hong Kong dollars back cheaply, right? So they want Hong Kong dollars to depeg, and then they can go ahead and buy Hong Kong dollars cheap, and then, right, cover their liabilities here at a cheaper rate, right? Does that make sense? They use the currency. They use the currency, it's strong. They borrow the currency when it's strong. They buy a specific asset that's going to be stronger in the future. And then they weaken the currency they can have to return. So their liabilities is much cheaper than before after the peg breaks. Okay, so they force HKMA, deplete the reserves. Once they have no reserves, Hong Kong dollar must depeg. In other words, depreciate, because they have no more US dollars to inject into the system, and therefore Hong Kong dollars must depeg. And their return, therefore, is the following, right? They buy it back at E prime, much cheaper. In other words, a more devalued Hong Kong dollar, right? Which exceeds the $100 they borrowed. It's greater than zero, right? It must be, if they're going to play this game. Make sense? I hope it makes sense. Okay, this is a kind of a trivial exercise. This is basically saying that even if you don't actually devalue your currency, the announcement effect can actually have an impact on E today. So think of the case of China. If they're going to devalue the currency, they don't have to devalue it now. They can simply announce it and will have an impact today. In which case, UIP will shift. In other words, E will change, and that's gonna allow you to achieve a higher exchange rate despite not having to devalue your currency yet. So the example I give you is here. So sorry, I'm going a bit fast because of time. But stop me if something doesn't make sense. Okay. So let me go over the graph here. We are this graph. We starting points here, and our starting liquidity preference curve is here. Okay. And what we're doing is we are announcing that the future exchange rate will be much more depreciated than before. So we're going from E, normal E to E prime, that's very, very high, and then saying that's a new peg. So E bar to E bar prime. And based on UIP equation, that's just saying that E is larger, right? And we all know what happens when E is larger, right? You have to have some way to decrease the right-hand side, and the only way the right-hand side decreases in UIP is if E increases. Yeah, so the UIP curve shifts just simply from the announcement. up to it should be, I guess it's not being drawn correctly. I mean, drawn well. It should be here. So think of that as a black dot. So subsequent analysis, you can also assume maybe this announcement has a also output effect. So that's what I drew here. Suppose there is an output effect. That's going to shift the liquidity preference curve upward. And therefore, if you don't do anything, you're going to have an interest rate of here. And you're not going to be hitting the bar, right? And if you are committed to the peg, you have to use your monetary policy tools to maintain the new E bar prime. That means you have to shift the money supply curve outward, right? So that you get back to R, right? So let me walk you through the steps again. We started at, our a given equilibrium point. China made an announcement that they're going to devalue the currency. The devaluation, the announcement itself is sufficient to have a change in the spot exchange rate, because all that's changing is E hat E, right? It's unexpected. It's a new benchmark. Nobody believes it because you already said you're going to benchmark to E bar, but now it's at E bar prime. UIP is going to be violated, in which case the spot exchange rate must be higher than before. In fact, it has to be precisely E bar prime in order for it to UIP to be true again. R equals R star. If there was a subsequent output effect from this announcement, we can model it, but just realize that if there is an output effect, the central bank of the home current country has to conduct monetary expansion to undo that interest rate effect coming from the output effect, right? Because if there's an output effect, interest rates want to increase, but that's a no-no because changes in interest rates will distort UIP away from E bar prime, in which case the country has to conduct expansionary monetary policy to restore R prime back to R. Again, reinforcing the idea that when you have pegged exchange rates, when you adopt the pegged exchange rates, your monetary policy is fully dedicated to maintaining the peg, right? If there's any side effects from it, it must be used to restore back to the peg. Otherwise, problems, right? Like otherwise you have a confidence problem. People won't believe you anymore. So so again, short run, long run analysis for pegged exchange rate is very boring, because short run, long run, it's basically the same. In this case, it's temporary output. You just pretend the output never occurred, and therefore, long run is just as if there's no monetary policy in the beginning with. So there's nothing really to think about when you do this kind of analysis for pegged exchange rates. Okay, so one interesting way that pegged exchange rates can be useful, besides enhancing fiscal policy, is using it to escape what's called the liquidity trap. So the liquidity trap is what's been described in Japan after they tried to conduct quantitative easing to get themselves out of a recession, which they failed. So they call it the lost decade, right? It's called liquidity traps because they hit the nominal interest rate of 0%. And just intuitively speaking, it should be obvious to you that if they suddenly set interest rates to negative, you would take your money out, right? Otherwise, you're most likely to take your money out. And so monetary policy is useless. But economists has proposed that, well, if that's the scenario, one way to get out of it is to do what's called is called devaluation of your currency. So that means commit to a peg and then devalue to that peg, and then monetary policy will be useful again. Okay? And my job here is to show you graphically why that's the case. All right, so in a liquidity trap, that means nominal interest rates is 0%, as I said, right? Monetary policy becomes ineffective, and I'll show you why using a graph. Based on UIP, if interest rates are 0, then the spot exchange rate must be equal to the expected future spot exchange rate divided by 1 minus R star, right? You can convince yourself that's true. You just rearrange the equations, okay? So here's the graph. This line here is it's supposed to represent the ineffectiveness of monetary policy. Let me explain to you why. So if you look at this equation here, MS equals P times L, R is 0, and then you have Y. So when you increase, let's say you try to conduct monetary policy when interest rates is 0. So you try to expand monetary policy, so this goes up. All else equal, you can't change interest rates. So the only variable that can change on this graph is Y. So what's going on is this graph is just shifting to the right. You concur? So when you increase monetary policy, interest rates stuck at 0. So the only other variable that's moving is Y. So moving this graph left and right doesn't help you, right? Because you only get traction, you only get an effect if it's moving up and down, which it is not, right? It is not moving up and down. It's only moving left and right. So in liquidity trap, monetary policy doesn't work. You see that? Interest rates are 0. Increasing MS only suggests that the AA schedule is only moving left and right. But that doesn't help us, right? Because we only get an effect if AA schedule moves up and down. We don't get it. So what economists has proposed that if we are ever stuck in a liquidity trap in which interest rates are 0 and we still want some way to boost output, what we should do is we should devalue our currency, or peg it to a devalued currency as a commitment device. And then once that's done, you can gain your monetary policy tools back as afterwards. Okay. So what does that mean? Well, that means changing E hat E, right? So if we change E hat E to a different level, then the entire AA schedule shifts up. And then there is a part in which output is high enough in which you get a trade-off between E and Y, right? Because you need that trade-off. So at this point here, then it's possible to shift AA schedule again, right? Because there is a slope, there is a exchange rate, so to speak, between E and Y. So that's the idea. Okay, so to summarize. When we are in a liquidity trap, we are at an intersection in which the DD schedule and the AA schedule are at a point in which changing money supply will have no impact on the AA schedule. It's just moving. If you were to change it, it just means that the entire graph is shifting left and right because interest rates are 0. But there is a certain point at which there is a trade-off between E and Y at this kink, and we need to find some way to change the AA schedule such that the kink is above the DD schedule, right? I'm just describing it graphically. And that's only possible if we use devaluation as a commitment device, saying that we're going to set a currency exchange rate target and tell the world that now we're going to devalue our currency up to that point. Expectations change. And once the kink is above the DD schedule, we will have recovered our monetary policy tools, in which AA schedule can now shift up and down again. So once we get out of the liquidity trap, right, then monetary policy is possible again. All right, comments, questions on devaluation as a way to escape the zero interest rate environment. We were at that environment for a while in the US, but we never thought of ourselves in a trap because the economy was growing. And unlike Japan, Japan's economy was not growing and in fact shrinking, and they couldn't do anything about it because people were just literally putting money in safes. I think someone said the only thing that was being sold or bought in Japan during zero interest rate environment was literal safes to put their money in. Okay? Everything, no one was using the money to buy anything else. You want people to buy money, then a way to get out of that liquidity trap is to devalue your currency and have a pegged currency for a while. And once you have that peg, you can then eventually recover your ability to conduct monetary policy. All right, so the rest of this stuff is just summarizing the trade-offs between flexible exchange rates and pegged exchange rates and so forth. So now you kind of understand the pros, right? The pros of pegged exchange rates and also to some extent the cons, right? Pegged exchange rates are good if you're a developing country, you want credibility. One way to do it is peg your currency to a reserve currency like the US dollar or British pounds or whatnot. And that can allow you to enhance your import, exports, whatever, achieve your current account targets. It's also useful in the case of fiscal policy. It's also useful in the case of escaping zero lower bound situation, but it's bad in the case of if you want autonomous monetary policy. So basically, you've given up all your flexibility, and it's all that flexibility is being dedicated to maintaining the peg. Okay. So the case for exchange rates, if you don't want reckless money printing, that's what a pegged exchange rate is for, right? Because they have their duties are clear. It's to maintain exchange rates between one currency with the other. If they needlessly print money or whatever, that's going to devalue the currency, especially to print money to pay off their debts. That's monetizing their debt. That's a big, you lose a lot of creditors that way. You do that, nobody's going to believe in the value of a currency, and there's no growth there's no real growth, and everything's bad. Okay, so examples of countries that that benefited from a fixed exchange rate are Ecuador, or dollarization. You have credibility evasion from liquidity trap from Japan. That's a proposal. And I think Argentina, although they haven't been doing so well, but adopting a currency board certainly helped them for a while. Okay, as I mentioned already, especially if you are a country that's facilitating international trade, like Hong Kong, Singapore, Switzerland, whatever, it's good for trade, right? It's good for trade and investments because you have it's backed by a stable currency, and people are willing. They don't want uncertainty, right? People don't like uncertainty, and when you eliminate that uncertainty, people want to conduct trade in your area. Credibility of exchange rate is essential. Right? That's the whole point. You want credibility, and one way to do that is to eliminate the uncertainty that you might devalue the currency just to, pay off your creditors. Okay. All right. I hope this is also obvious, right? If you have a pegged current exchange rate, it's going to eliminate monetary fragility, because there's no monetary shocks anymore. Monetary shock just means sudden change in MS from somewhere. If you have a whole system of fixed exchange rates, everything is dedicated to maintaining exchange rates. There's no more money supply shocks, right? Obviously. Domestic fiscal policy interventions are super effective because they're done in conjunction, right, of monetary policy. And they're doing that because they want to maintain that pegged exchange rate. And like the gold standard, right, you get some degree of economic policy coordination, right? If everybody does pegged exchange rate, no uncertainty, international trade is deterministic, and people are happy. But of course, you can make the same case for floating exchange rate, right? It's kind of the, it really all depends on who wants to deviate away from the system. All right, the case for floating exchange rate. Automatic stabilization just means that you allow speculators to come in to restore economic sense into the markets, right? So if UIP is violated, you expect people to have the freedom to come in to restore parity if something doesn't make any sense, right? So, for example, I talked to you about the peso problem, right, in which expectations are totally wrong. So you allow that markets to fix itself. If you delayed it, it could get worse, right? So you want people to gather information and to make those speculative trades, and that's automatically stabilizes the system. You want people to speculate, discover new information. Elimination of attacks. So I told you the major problem with the pegged exchange rate is you need to have enough reserves to defend your currency in a scenario in which the pegged currency is getting too strong. If it's getting too strong, you need to flood the market with the currency that's getting too strong. But if you run out of currencies to sell and flood the market, you have to depeg, right? That's the problem of a currency attack. But under floating exchange rates, you don't care, right? You're not your central bank isn't maintaining your reserve. There's no peg to worry about. So whatever value it is what it is. And sustainability. So some people claim that pegged exchange rates by definition are unsustainable in the long run because you can't predict economic activity far into the future. But under floating exchange rates, it's by definition stable because nobody cares about its value. Nobody has any sort of goals or target. Okay. Floating exchange rates are good because monetary policy is very effective. And we learned that last week, right? Especially if it's unanticipated, unexpected, you have that change in E hat E and you have the change in MS. That's going to give you an amplification of the change in the spot exchange rate and therefore the output effect. This is something you cannot do under fixed exchange rate. So we said the same thing for fiscal policy, right? So two types of policies now enhanced depending which one you adopt. Economic coordination, as I said, right? What those exchange rates are, and there's limited economic price fragility, right? But you can also say the same for economic coordination for floating exchange rates. Think about like just think about like they say brick maybe, so that's also possible, but maybe not a smart idea. You could, if you want to make your countries more correlated with each other, it's still possible, right? Think about the countries in the EU, right? So the EU did what they did because they are able to basically give other countries who need the credit better credit, right? So they adopted a single currency and therefore they issue a single type of debt. And they said, this debt represents all of us. The alternative is everyone issues their own currency and issues their own debt. And some countries may not get the same level of credit as others, right? And so when they decided to go for the EU, there's essentially consolidated their credit together, right? So that's one way to coordinate under a floating exchange rate, right? Again, different definitions of coordination, but still achieve basically the same idea. Okay. And lastly, symmetry. I think this just means fairness, right? So if you have symmetry, you allow the country with the most creditworthiness become the reserve currency. So that's just economics, right? It's efficiency. Countries that exports the most things the currency should be the most in demand, and therefore that currency should naturally dominate. If you if you decide to intervene and have pegged exchange rates, that kind of distorts things a little bit. Okay, so those are the basic ideas. And we can obviously summarize these trade-offs in what's called the policy trilemma for open economies, which is basically saying that you can't have it all. If you peg, you can't have floating. If you have the features of floating, you can't have all the features of peg. So there are trade-offs that you can't have it all. I mean, you can't have all the benefits from every type of system. And there are basically three types of benefits that are that come about from these regimes. Number one, we have capital mobility. You can kind of already see which regime gets this, right? Floating exchange rate gets capital mobility because they don't care where the money goes. Okay, they're not maintaining it. But if you're doing a pegged exchange rate, you do care, right? You do care because having capital flow in and out can change the exchange rate. Exchange rate stability, this is obvious again as well. If you have pegged exchange rate, there is no uncertainty what prices are, foreign currency prices are. If you have floating, you have all the uncertainty, right? Everything. And then monetary policy autonomy. And this should be clear based on the examples we went over today. If you want to peg currency, your monetary policy is fully dedicated to maintaining the peg. You can't use it for anything else. If you do, it's going to break the peg. All right, so let me finish up this slide and then we'll call it a day. And I'll go over the review slides next week. All right. So based on these descriptions, it should be obvious you can only choose two, right? You can only choose two out of the three. So example one, you can have a fixed exchange rate with capital mobility. This is fine. This is possible. But in doing so, you have to give up one of them, right? You have to give up monetary policy autonomy. So this is Hong Kong. You have free flowing capital, you have fixed exchange rate, but in doing so, you realize that you can't do monetary policy to stimulate the economy. All right. Let's say we still have capital mobility and we have freely conducted monetary policy. You can't have fixed exchange rate. You can't remove the uncertainty. This is the US, right? Because they have a floating exchange rate. They don't care what the US dollar is to any other currency. That's because every time they change monetary policy, money supply, they're going to change the exchange rate. Therefore, they can't manage the exchange rate. And lastly, if you choose fixed exchange rate and monetary policy independence, then you must control capital flows because changing capital flows will change the exchange rate naturally. So this is China. I hope that's obvious to everyone now, right? Hong Kong fixed, we allow capital mobility. Whenever there's movement in capital mobility, we have to intervene with monetary policy to restore the peg, right? That's the whole point. Monetary policy is dedicated to maintain the peg. That's Hong Kong and Singapore and so forth. US is laissez-faire. They don't care what the exchange rate is. They want to use monetary policy at will to satisfy their internal governance. Whatever it is what it is. And also free capital mobility. So all these things will make the currency float to whatever value it could be. And they're not going to exert any effort to maintain the value of the exchange rate with any other country. And lastly, if you choose a fixed exchange rate and independent monetary policy, then you have to control capital moving in another country. Otherwise, the exchange rate will break, right? So that's China. So people like to draw triangles in the textbook, so I drew a triangle for you here, okay? So at one corner, you have exchange rate stability. Again, that means that there's no uncertainty about the value of the price of foreign currencies. You have another angle here, monetary policy autonomy just means they can change MS at will, okay? Can the central banks do that? Well, it depends. And lastly, capital mobility just means there's no interference of investments inflow and outflow. And I've written these cities and countries on each of these corners because that's their choice. US chooses monetary policy autonomy, capital mobility, so that's why it's on this side. China chooses exchange rate stability and monetary policy and autonomy. That's why they're here. And then Hong Kong and Singapore and so forth have exchange rate stability and capital mobility. So they're on this side. Okay. So it should be clear. You can't have it. You can't have it all. You cannot have it all. All right. So that's all I have for you today. So sorry for going over 3 minutes. I promise to summarize this slide again because I think it's a good review, and then we'll move on to risk management topics. All right. So I'll see you guys next week. So there's no quiz, just to make sure. And yeah, let me know if you have any questions. I'll be around for a few minutes. Otherwise, have a nice evening.